Hi everybody, I hope you're doing well. It's definitely tax season around here. It's getting a little more intense. This video will be a little shorter perhaps than the last couple, and thanks for your patience as we go through this really intense time. Today we're going to talk about clearing up some confusion around what deductions are available on your personal tax return and demystifying standard deduction versus itemized. So everyone who's filing a tax return gets a standard deduction. If you are single or you're married and you're filing separate, it's around $13,000. These numbers go up a bit every year. If you're married, it's $25,900 for 2022. Head of household, $19,400. Note that to claim head of household, you have to be claiming a child, or you have to have a dependent child living in your home, whether you're claiming them or not. If you're over 65, you get an extra standard deduction on top of that. And so this standard deduction is an amount that you will not pay tax on. On your tax return, add up all of your income, subtract the standard deduction before calculating your tax. You can alternatively itemize your deductions. And what that means is adding up these deductions, your medical expenses, which only count if they're more than 7.5% of your income. That's a large chunk of your income, and hopefully that's not the case for you. Your taxes, which would be real estate taxes, sales tax, your RTA excise tax when you register your tabs. If you're in a state outside of Washington, it would be your income tax for that state. Those taxes are capped at $10,000. Your mortgage interest, which is limited if your mortgage is larger than $750,000. And then your charitable donations. So donations of giving money, donations of giving stuff to Goodwill, those sorts of things. Please note that you need to have documentation and receipts for those things. Definitely talk to us if you need to know what those requirements are. But if all of these things don't add up to be more than that standard deduction, then itemizing doesn't help you. We'll take that standard deduction because it's more. If these things are more, that's great. Then you're itemizing your deductions. There are a few things that people often think they have to be itemizing in order to deduct, and that's not true. So your business expenses, if you have a sole proprietorship, if you have a business, those business expenses are not part of itemized deductions. They are expensed against that business income elsewhere on the tax return. You get to take those whether you're itemizing or not. There is no standard deduction for business. Same with your expenses if you own real estate that you are renting out. Those rental expenses similarly get deducted against that rental income elsewhere on the tax return. So those get deducted either way. There are some deductions that have always been part of itemized deductions until 2018 when they went away. But we still often see them pop up in paperwork from clients. So the cost of your safe deposit box, the cost of your tax preparation for your personal return, investment fees, expenses for doing your job as an employee, like home office for an employee, those sorts of expenses as an employee. None of those things are currently deductible. It's possible they'll be back after 2025, but at the moment they're not deductible. So hopefully this helped clarify a little bit about what itemized deductions are and what's included, and what the standard deduction looks like and why we're taking that much more frequently these days. Let me know if you have additional questions, if there's anything that we can answer in a future video. Feel free to subscribe for these weekly videos, and have a wonderful week.